Will Powell break the economy? Hi, everyone. I have Adam Taggart with me once again. It's been a long time since I've had Adam here. Adam, how are you doing?
I'm doing great, Mike. And I think it's been a little while because you've been very busy with a lot of work on your end. You look like you're holding up well, though.
Well, yeah, I'm trying to, not getting much sleep. But anyway, I wanted to go over some of the inflation indicators and the recession indicators. And you do this like every week with Lance on your weekly wrap up, right?
We do, and also a lot of the guests I have on, in between those weekly meetings with Lance, this stuff comes up a lot too. And I got to say, Mike, you pulled a bunch of charts together here. I don't know how you had the time to do it in between all your book writing and your traveling and the other stuff that you're working on, but you've got some great data here to go through.
Well, about 3 months ago, I did a video on inflation and recession indicators, and I opened that video with, the experts. When it comes to recession, the experts are predicting yes, no, and maybe. Here's why. Because there's a lot of indicators that disagree, although one of them that I went over 3 months ago has now flipped toward indicating recession. But most of these indicators are leading indicators. They will turn negative several months before a recession sets in. And then you don't know about the recession until we've already had 6 months of that recession. It takes 2 consecutive quarters of GDP contraction for them to really label it a recession, although the government is now trying to redefine what a recession is to convince us that we're not going into one.
Right. And that's not even the official definition of recession. It doesn't usually come out from the National Bureau of Economic Research until usually several quarters after the recession's already over. I mean, it's not helpful at all from a signaling standpoint.
Right. And so, Lance has come up with a whole bunch of indicators. I've taken some of his that I'm using now also, but I already, I've been grabbing indicators from different things where I can look back historically and see how accurate they were. So the first chart is just, I'm starting here actually with the 3-month Treasury bill, because this is, will Powell break the economy? And here we see the sudden rate rise, but then the next chart shows the rate of change, starting off from just 0.25 and going up to, well, actually, that's the Fed funds rate, 0.25. But the rate of change, there's never been anything like this in the history. Actually, there were some huge rate increases during the Great Depression. None of the charts go back this far into the Great Depression. So I can't measure this without a different database other than the Federal Reserve's. So got any comments on this rate of change?
I absolutely do.
Okay.
So the way I like to think about this, and we might have talked about this a few months back ago, Mike, is here's why rate of change is important, right? If I gave you a gallon of water and I gave you a week to drink it, you'd have no problem with it, right? But if I just cram that gallon up against your mouth and forced it down your throat all at once, you might drown, right? So it's the same amount of volume of water. It's the rate of change that's very different in both scenarios, right? So this is highly likely to create some sort of, systemic jolt shock to the economy here, because it is happening so quickly and so dramatically. So it's the fastest and it's the greatest intensity of rate of change that we've seen in the data series. I think it's highly likely to expect, if not a full breakage, at least, some trauma to the economy as this shock, basically electrifies it.
Yes, I believe that this has to end in a crisis. The next one is the Fed funds rate, and then the rate of change after that. And it's even greater than the 3-month. I mean, it's huge. And the Fed funds rate is what trickles down into every facet of the economy. This is the reason, the Fed funds rate is the reason that the 3-month has gone up. When you talk about like the 10-year, those prices and interest rates are mostly set by the free market. Fed has very little control over that. The closer you get to the Fed's funds rate is instantaneous. As you get toward the 3-month, Now the Fed funds rate has an effect on it, but not direct control still. So this Fed funds rate, look at I mean, this is many, let me see. 1, 2, 3, 4, 5, 6, 7, 8, 9. It's like 9 times, 8 times at least, any previous rate of change. Any comments on that? Is this insane or what?
Well, yeah, it's certainly very extreme. And something that's also really important to keep in mind is that there is a delay between when the Fed pulls a lever and when you see that manifest out in the real economy. And it's a squishy duration, but if you kind of average it out, it's about 9 months. So as extreme as this shock is that we're talking about here, we haven't really felt the shock wave from it yet in the system, because these hikes have happened mostly over the past 6 months or so. The most intense hikes have. So we still haven't hit that 9-month anniversary from the ones that were made 6-7 months ago yet. So we still have a lot of so if you're looking around and saying, well, it doesn't look like too much is breaking just yet. Well, it's because we haven't seen the full manifestation of the hikes that have happened so far. And just to be really clear, the Fed is not done hiking. Right? They're still guiding that they're going to do 50 basis points at their next meeting, probably going to do maybe 25 basis points at the few next after that. But the point is there's a lot of people that are arguing. Like, I was just talking to Jim Rickards about, what the Fed's doing. And he said, what the Fed should do is just sit on its hands here, right? It's done enough. It's probably already broken something. We're going to find out as those shockwaves hit. The fact that it's continuing to hike into this means, if indeed it is tipping us into recession here by this extreme tightening and hiking, it's just making it worse, or it's making it worse than it's going to need to be by continuing to put on the brakes here as we go further into this new year.
It amazes me that these people, they've all got these economic degrees. They're considered the world experts. They're running. There's really nobody more powerful than the people that run the Federal Reserve, not the U.S. president. I mean, the people at the Federal Reserve can't launch nuclear missiles, but they can certainly launch a financial nuclear bomb.
Right.
And that is what Powell is doing. And he doesn't even realize that delay that you're talking about. And that delay that you just mentioned is going to show up in all these recession indicators that we're going to go over in a moment. The next one is the 30-year fixed mortgage rate. And this is another one of those things that takes that 6, 9, 12 months to get through the economy until it really triggers something and something breaks. And this could be, more and more every year, the economy, every facet of it becomes interlinked. It becomes, there's a transmission between different sectors of the economy that is becoming very, very instantaneous. And it doesn't matter where it is in the world. And right now we've got China's real estate market disintegrating. There's threats all over the world. And what we saw from the COVID crash, the 2020 market crash, and the recessions that happened after that is that all economies on the planet are becoming hyperlinked. Ever since the 2008, that was the first one where we saw it was almost instantaneous. All the economies around the world experiencing recession at the same time. This next one, is the 30-year mortgage rate, but then again, the rate of change. There's never been anything like this. And remember, raising rates was part of what caused the 2008 crisis. And when you look at how slow and careful Greenspan was at raising rates, and then Bernanke took over and he went along with the same deal for a while, and they said, oh, there's no problem. There isn't any real estate bubble. And then all hell breaks loose. But look at this 30-year mortgage, and this goes back to about 1970.
Yeah, so there's been no, in sort of recent decades, there's been no rate hike campaign that wasn't followed by a recession, right? Where they tightened too much, the economy began to seize up. So you can certainly ask, well, why is it going to be different this time, especially when we are hiking much faster than we've ever done before? One thing that's really important to note, though, is the amount of debt that's in the system. So when you raise interest rates, you raise the cost of debt service, right? And going into 2008, the US federal debt was, I believe, $9 trillion.
Yeah.
Now $31 trillion, 14 years later, right? So almost, what's that, 3.5 times more. So we are playing with much more fire here, right? The point of this is that when you have more debt, you likely can handle a lower terminal rate, which is basically the fancy term for how high can they raise rates before the wheels really start coming off the economy. And so we very likely may not be able to withstand the same rates that we had back when Bernanke was raising them prior to 2008, right? The breaking point is probably a lot lower. In fact, a number of the people I talked to, they think we've already passed it, right?
Yeah. I'm sure that we have. I mean, one of the things that you mentioned was that delay. Well, that delay, if that's 9 months, if it's 6 months, 9 months, a year, before the results of what the Fed does actually manifest themselves in the economy, that delay allows them, when they're doing this rate of change, to go, so many more rate hikes beyond what is going to break the economy. The break happens from what was done 6 or 9 months ago.
Right.
And they're able to stack 2 or 3 more rate hikes on top of that, meaning that when it breaks, it's going to break so much worse. It's going to last so much longer. And so the next chart that we've got here is just the 10-year Treasury, because this is what all of the analysts use, this minus the 2-year Treasury. So you've just got 2 sets of interest rates, 2 sets of yield on bonds that you're deducting one from the other. And when you do that, you get this 10-year constant maturity minus the 2-year constant maturity. And this is the bellwether that everybody uses for measuring, are we going to go into a recession? And what's interesting, you had said that something breaks later. And if you look at this, it goes negative. I mean, this goes all the way back to 1975, it looks like. But it always turns negative 6 months, a year, 2 years before the recession actually happens. But it's been extremely reliable, except for one little false flag event back there in the late 90s, before the 2000 crisis. But it's saying that there is a recession in our future. Any comments on this standard of the industry?
Yeah, I'm glad you bring this up, because it really is one of the industry standards, maybe even sort of the gold standard for predicting recession. This is, folks, when you hear about the term an inverted yield curve, that's actually what this is measuring. It's comparing the yields of 2 different duration debt instruments. And basically what it says is that investors are demanding a higher yield for shorter duration bonds. And that actually doesn't make normal sense, right? You would think that if I lent you money overnight, I wouldn't charge you that much in interest because it's not that long of a period, right? But if I lent you money for 30 years, well, I'd want to charge a higher interest rate because there's just a lot more that could happen in that 30 years, right? You could go bankrupt, you could skip town, whatever, right? So I'm going to demand a higher yield. What happens when the yield curve inverts is that investors are demanding a higher yield on the shorter duration instruments. And basically the interpretation of that is the market is saying, we think that something's going to happen in the near term that we're worried about. We're not so worried 30 years out or 10 years out. We think things will have resolved by then and the world will have gone back to normal. But we are worried about the upcoming, next year or 2 year, depending upon, which yield curve you're looking at here. So that's what this is telling us. And the reason why we should pay such close attention, as you said, Mike, is if you look at the data, it is one of the most dependable predictors of coming recession. And right now it is saying recession on the way.
Right. It's saying, it's a risk indicator. All the market of the bond market is just investors trying to guess how much risk there is. And it's all these millions of people trying to figure this out. And when they say that there's more risk 3 months or a year or 2 years down the road than there is 30 years down the road. That is something. And that's exactly what this is saying, that there is more risk in the next 2 years than there is 10 years down the road. And what's interesting is this even, do you remember in 2019, there was a liquidity crisis in the repurchase agreement markets, which affected only the banks. We didn't see it really flow over into the economy. But there's a tiny little blip before the 2020 recession. I find it amazing that the markets could almost predict COVID.
They almost, it almost looks like they predicted the black swan of the pandemic. Yeah.
Right. Yeah. So the next one is the 30. I took the 30-year minus the 2-year.
Now, hey, Mike, real quick, before you talk about that, just on that last point there, there are a lot of people who aren't saying that inverted yield curve, knew that a pandemic was coming. But what it was saying is, it was saying that the economy is getting to a weak place. Yeah. And that in most people's interpretation, COVID was just the match that lit the issue. So even if we didn't have the pandemic, we may have actually had some sort of economic event in 2020, given the state of the economy at that time. Now, we'll never know, because COVID happened and that, drove all the action for the next 2 years. But it's important to note, just because even pre everything that happened after COVID hit, we were still in a vulnerable place economically. So even though we're coming out of COVID, a lot of that underlying economic, issues that were not addressed because we scrambled to deal with the pandemic are still there, and we still haven't solved them yet.
Yeah. And so this has 6 recessions in it, and 6 out of 6 times it predicted the recession. So that's an important stat. It goes back to 1975. So here is nobody uses this. Maybe Lance does, but I took the 30-year minus the 2-year. And other than the pandemic plunge, the COVID crash, so 5 out of 6 times this predicted it. And if you notice, all of these predict it before the recession happens. So we probably still have some time left. But I want to move on to the next indicator, the 10-year minus the 3-month. And that one is, let me see, I wish it went back further, because it's probably very accurate. And as you get into these shorter time spans, it predicts the recession closer to the actual onset of the recession, instead of saying there's going to be a recession within the next 2 years. It's saying, well, there's going to be a recession within the next 6 months to 1 year. So I like these. And look at how accurate this one is on the lockdowns and the COVID crash, that disruption in the markets of the repurchase markets becoming illiquid, and freezing up, and interest rates shooting up in that particular market, which most people don't even know about. And it's beyond the scope of this video to really go into what that is. But I just find it interesting. I'm just going to skip to the next graph, though. This is the 10-year minus the Fed funds rate. And the nice thing about this one, it goes all the way back to 1960. So you have 1, 2, 3, 4, 5, 6, 7, 8 recessions in this one. And this one is 8 for 8. It's a very reliable indicator. Any comments on that? And do you normally look at this? Is this a new one? And what's happening here, if you notice, the other ones were said the 10 and the 30 minus the 2 were saying recession is coming. The 10 minus the 3-month just flipped. It was not, it was saying that there wasn't going to be a recession 3 months ago when I did a video. This is the one that has now flipped and agrees with the other 2. But then when we get to this, the Fed 10-year minus the Fed funds rate, this is saying that there shouldn't be a recession, but this one gets even closer. So I would imagine that this is going to flip soon. It's measuring it much closer. When it goes negative, a recession is going to happen sooner than the other indicators.
Yeah, and I think the important thing to know about these, so you mentioned Lance a couple of times. Lance looks at all of these, right? And it's not an all or nothing type thing, right? You don't. It's
Right.
not like they all have to go invert before the recession can happen, right? It's
And
more of a
sometimes the
probability game.
majority rules, right?
Yeah, exactly. So, what you're just looking at is you're looking at the board here and you're saying, okay, probabilistically, what is it telling me? And, you've done a great job of just walking through enough data here to say that, hey, this data is screaming pretty loudly. And so what does that really mean for people watching this video, right? From a practical standpoint, it's that, hey, there is a high likelihood that we're heading into recession, right? And it's not guaranteed, but I would say, given what the data is telling us here alone in these charts, it's something you should be preparing for. Now, if we're using our eyes and we're looking around the rest of the economy and the data that we're seeing there, there's a preponderance of additional data that says that we are entering into recession too, right? And we can argue about the definition of a technical recession. At the end of the day, what I always say is it doesn't matter what you call it; it matters how people are feeling it, right?
Right.
And if you're looking at, what's happening in home prices, if you're looking at the layoffs that are going out there, if you're seeing the inventory build up at all these retailers that nobody's buying anymore, if you're looking at the worst market that we've had in, past decades for both stocks and bonds combined, there's just so much data adding up here that says, hey, look, the economy is really struggling here. It looks like it's going to continue to stumble going into next year. We should really be asking ourselves, okay, personally, how vulnerable are we? And what steps should we be taking right now in advance so that if it indeed does happen, we're less impacted by it than we would be otherwise? And this might be things about, if you work for a paycheck, doing a lot of the wargaming of like, okay, what if I lose my job? Maybe I can, do some advanced planning on who might support me and my family, or decisions we might make as a household in that case. Maybe I can be storing additional emergency funds together right now, so that if I do get laid off, I've got enough of a bridge to make it to my next job. Maybe I can start actually looking for my next job while I'm still working right now. There's a whole bunch of other things that are going on. Certainly, you can do the same thing with your portfolios as well, right? And yeah. I don't want to get into the full range of things. Obviously, if you're expecting the kind of market turmoil that could come along with this, yet one more reason to be, buying hard assets like gold and silver. But also, there's some really interesting things going on because of these higher yields now. They actually, for the first time in forever, are providing market participants with an alternative to just being long risky stocks. You're finally being able to get a decentish yield off of some of these debt instruments that are safer than many equities. I don't want to, sit here and make the case that bonds are the safest thing around. And you do a really great example, Mike, of explaining why hard assets in general are better than owning paper assets. But especially in terms of a place where you can park some capital in the near term, next 6 months, next year or two, get paid for it, and actually have some optionality value. And what I mean by that is if you buy, like, let's say you buy the 30-year treasury right now, where you're going to get paid over 4% for that, which, yes, it's less than the CPI right now, but CPI is coming down, and maybe someday you might get close to a real return on that, but it's better than the nothing that it was practically paying you, last year, right? But in addition to getting paid and having the guarantee of the government that, you're going to get your money back if you were to hold to maturity and all that stuff, if the Fed does break something and it is forced to pivot and it is forced to start bringing interest rates down, the value of these bonds, today's bonds, is going to go up. And it's the longer duration bonds that are going to go up the most. So in my example of the 30-year US Treasury, you're getting the safety of being in a treasury, you're getting paid a decent rate. And if the Fed does pivot, you might actually get some really substantial price appreciation there, 30, 40% or whatever, depending upon how extreme the pivot is. So there's some interesting opportunities that are beginning to emerge that weren't there in the past decade, where the Fed had just crushed interest rates artificially.
Yeah, these are short-term opportunities. These are trades that you have to make. I believe that the scenario that you've laid out is actually the one that is going to come to pass. You've got these fairly high interest rates now. The Fed will pivot. The value of the bonds goes down as the Fed keeps on raising rates. These bonds will keep on going up. You're getting that interest, but the value in the secondary market of the bonds is actually falling as they raise rates. But when they pivot and drop rates, and they will drop them back down to zero, when there's an emergency, because they're going to cause a huge crisis. Then those bonds shoot to the moon, and hopefully you sell them then. You make both a big capital gain, and you were sort of getting paid something, even though it's a negative real rate, with inflation being higher than what you're getting paid. But as this goes up and the dollar is going up, it also suppresses the price of gold, which gives you an opportunity to buy at an artificially low price. And I have a moral issue with bonds. I just won't participate in them because I don't understand bond investors. They're investing in something where the government is promising. This is a promise from the government to tax you in the future to pay you back. So you're going to invest in something and support a market that, and I realize that one person just sort of boycotting this market, but it's a moral issue for me. I just cannot participate in the bond market simply because I'm investing in my own taxation in the future. It's an immoral thing. That's what gives the bond value, is by enslaving the population in the future. Everyone has to pay taxes to pay the principal and interest on the bond that you invest in today. If there's no market for the bonds, then the bonds go away and we don't have this enslavement in the future. So yes, I'm a little bit nuts, but I look at this from a very, very large perspective, and it's just an immoral thing, and that I won't support, and so I don't buy them.
Well, and you're investing
it might be a very good short-term trade. What?
Yeah, well, you're investing your values, which at the end of the day, every investor should do, right? That said, it is important to understand what the rest of the investing world will do, and the majority, sadly, yes, Mike, doesn't look through the same lens as you. Though I do want to say that if this pivot happens in the way that you described, it is highly likely to put the strength of the US dollar into reverse during this pivot period. And that is going to be hugely gold and precious metals friendly.
Yes, right. And with this currently artificially suppressing the price of gold, it just gives you that much more of an opportunity. And then, so the next one, the 5-year minus the Fed funds rate, this one has 8 recessions in it. It's 8 for 8 predicting these recessions. It is saying currently no recession. The next one after that is the 3-month minus the Fed funds rate. And this one goes back into the 50s. Now there is the very first one in, I think that's 57. It was positive when the recession hit. However, it had been negative just before that. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 out of 10 times in the past, it has predicted. Now, it did dip into negative territory just a few months ago. It's quite positive right now. And then the last one of these is the 1-year minus the Fed funds rate, also saying that that a recession is not imminent. It's disagreeing with the other charts. So I just find it interesting that the people predicting a recession, there's a group that says yes, a group that says no, and there's a group that says maybe. But more and more, we are turning toward the yes.
Well, absolutely. And if I can make just a quick resource here, Mike, bank drum for much of this year. And the big reason why I do that is because I'm concerned about the regular person, especially who's been told and still is being told, hey, the economy's strong, the job market's strong, right? But it's getting to the point in my mind where it's like the weatherman is telling you it's sunny skies on TV, but you're looking out the window and you're seeing the rain, right? My concern is the people that are basically going to get caught by surprise from this if we end up having a bad enough recession where there's a lot of substantial layoffs. And so, like I said, now is the time to be doing your preparatory work for what might be coming. And there's just a free resource that I put up on Wealthion that there are steps that you should be taking now in advance that are just preventative. But they're also, if you end up working for a company where you come in one day and you've got a pink slip because your company's just announced a bunch of layoffs, there's a lot of steps that you need to take, you need to know to take in those first couple of days, first couple of hours in certain cases. So anyways, if you work for a paycheck and you're interested in this, just go to wealthion.com/layoffs. And there's a free guide that you can download and read at your leisure. But again, for all the reasons that Mike just went through with this data that says odds are pretty good that a recession is coming, you should take as many preventative steps today as you can.
I'm pretty sure that you feel the same as I do, that this is going to be more than just a recession. This is going to be a full-blown crisis. And Powell seems bent on, they created all of this currency. They created the problem. Now they seem bent on making all of us pay for it. The number of businesses that, if you're a business owner watching this, Powell is trying to put you out of business. And the employees that work for you, they're going to lose their jobs when you lose your company. This is so immoral and just wrong that one person, and then this group, the Open Market Committee, 12 people, can think that they're smarter than the economy and that they know how to do this. And this is all the fault of Ben Bernanke. Powell and Yellen are trapped in this. Ben Bernanke created a short-term solution for a long-term problem. And he was putting a Band-Aid on cancer and concealing it. And now I don't know if the patient is terminal or not.
Mike, are you talking about Nobel Prize award-winning Ben Bernanke, the man who saved the world?
Yep, the man who destroyed the world, the financial world.
Yeah, well, and I do agree with you, Mike. And just to your point about sort of the impact that businesses are taking, there is an article that just came out. It says that 37%, so more than 1 in 3 small businesses could not make their full rent payment last month or quarter. I can't remember the exact duration, but it's just a sign, a symptom of what you're talking about there. Is we're already seeing a big swath of small business America begin to buckle under this.
Yes. So I want to thank you for being here. And then there was a meme that, typically I don't like to use memes that are from one political party or another, but inflation, that's the price we pay for those government benefits everybody thought were free. Mm-hmm. So I want to thank you very much, Adam, for joining me and giving your comments on all of this. It was great.
It's always a pleasure, Mike. Thanks for having me.
At GoldSilver.com, we have a price match guarantee, free shipping, and global storage options. Get the best-selling book, Guide to Investing in Gold and Silver, for free at GoldSilver.com.